I'm up on Mount St. Helens. We're out hiking, with my son and his class, and all this economic news is happening. I have no cell phone signal. I feel like the kid that's lost out there in the forest, and I can't figure out what's happening. Get a text message from you. Are you eating popcorn? You ready to watch? No, I'm not ready to watch. I have no internet. CPI measures price changes and a volatility in these price changes and what a consumer pays over time. So CPI came out this week and it came in at 4%. Now, what really happened there was we had this base effect drop off. Consumer price index is actually, it's an aggregate. It's January, February, March, or wherever you're at. It's the last 12 months. It's what did that change in price happen for that month, for the next month, and then they add it all together. We had the second largest month. We've talked about this on previous episodes. If you want to go check them out, just go check them out. But the base effect, the second largest month just fell off. So we had a 1% in June of 2022, and that was replaced by 0.1. I had to look down in my notes to make sure it was the exact number. That means the CPI for this month changed by 0.9, 1% minus the 0.1. That's why it dropped so much. See, everyone looks up and they go, we beat inflation. I'm sorry, we didn't beat inflation. We're gonna get into that next with the PCE and then also with what the Federal Reserve said, but we didn't beat inflation. The base effect, that rolling off, looked really good, but it's still sticky with us right now. Next month, we're gonna come down into the low threes and everyone's gonna be like, we won the battle. So next month, the base effect is 1.3 is what's rolling off. With the 1.3 that's rolling off, we'll get down into the low threes for CPI. The problem is the stock market was already starting to respond positively. People were starting to expect interest rates to go down. We're wanting the Fed to pivot. We're wanting the change. And I'll be honest, I was a little emotionally disappointed too. What we're really looking at, and this is the but, we need those inflation numbers to be about 0.2 or less. So 0.1 to 0.2 every month for it to add up to less than 2%. Remember, the Fed's target is 2%. So 0.1 was great this month, and that base effect of 1% rolling off, great. But we've got to continue this trend, and then PCE has to continue this trend too. See, because the average consumer, and what the news always talks about is PCI. What the Federal Reserve measures inflation against is PCE, personal consumption expenditures. The problem is that one is showing more hot than PCI. And so the Fed's actual metric, the thing that they're going to use to lower interest rates, is showing hotter. When you look at PCE, we take out the core, we take out food and energy because they're more volatile. The problem is that PCE has been hovering since December between 4.6 to 4.7. So even though PCI, we had the big number drop lower, the Fed doesn't care because their preferred metric, not what the media reports, is saying that it's still running a little hot. So just like we talked about in previous episodes, inflation is sticky. This is going to take longer. This was emotional to me personally because I want the Fed to pivot. I want lower interest rates, or I want a hardcore recession. I either want a hardcore recession or lower interest rates. Lower interest rates make my deals cheaper. Hardcore recession, make the prices cheaper. I just want to buy more real estate. With PCE not going lower, the Fed, so they had their Fed meeting. The expectation was the pause. But what the market wanted emotionally, and what I want emotionally, is the pivot or the change. In other words, we want interest rates to go back down. What we forget is long-term inflation is really sticky.